Hello and welcome to Simplicity in Stocks. In these videos, we'll dive into the important foundations of investing. Today's topic is interest rates and how they affect stock market investors. There's been a big talking point in the Indian stock market recently, that is the upcoming interest rate cut by the US Central Bank, the Federal Reserve. This topic has been in and out of the news with regularity for more than a year, but now it looks like the interest rate cut will finally happen. This decision by the US Fed is expected on 18th September, that is 19th September in India. Why is this important for Indian investors? To understand that, you will need to know the relationship between interest rates and stock prices. In financial markets, interest rates and stock prices tend to have an inverse relationship. When interest rates rise, there is downward pressure on the stock prices. When interest rates fall, stocks tend to do well. Of course, this is not a simple relationship. There have been many periods when this did not hold. However, it's mostly true. This is because the benchmark interest rate in an economy is a good estimate for the cost of capital in that economy. The benchmark interest rate is usually the interest rate or yield on the 10-year government bond. In India, it's about 6.8% at the time of recording this video. The interest rate on the 10-year government bond affects the borrowing cost for the entire economy. This includes individuals, businesses, and the government. Higher interest rates reduce borrowing and thus slow down economic growth. The reverse is also true. As interest rates fall, borrowing becomes cheaper for individuals, businesses, and the government. Thus, economic growth gets a boost. In a growing economy, companies sell more goods and services and thus make more profits. This in turn drives the stock market higher. So this is a good thumb rule to remember. Falling interest rates, good for the stock market. Rising interest rates is bad for the stock market. Please note that this is not a hard and fast rule. Now, this brings us to the anticipated rate cut. Before we come to that, just remember that this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Now coming back to the US Fed, the Indian stock market, along with financial markets all over the world, are expecting the US Fed to start cutting interest rates. In fact, this has been the expectation for quite some time. During COVID back in 2020, the Fed cut interest rates to zero to help the US economy. However, when the US economy recovered, it began a very rapid series of rate hikes. This was done to curb inflation. But now that US inflation has reduced a lot, the Fed will start cutting rates again. There is also a genuine concern that the US economy is slowing down. So the rate cuts could help the US economy avoid a recession. This scenario, in which the Fed cuts interest rates while inflation continues to fall and the US economy does not go into a recession, is called a soft landing. This is what the market is expecting. Now the market expects the Fed to start its interest rate reduction cycle in its meeting this week. But what happens after that? The stock market is likely to respond strongly to the statement the US Fed makes about the number of rate cuts and the speed with which the interest rates could come down. If investors are satisfied with the Fed's plan for future rate cuts, we should see the stock market go higher. But if the Fed disappoints investors with its plan for future rate cuts, then we could see a correction in the stock market. So should Indian investors worry about this? Well, if you are a long-term investor, the simple answer is no. As long as you have bought high-quality stocks at a good margin of safety, you will do well in the market over the long term. This is why serious long-term investors should hold on to their high-quality stocks and clean their portfolio of any junk stocks. Indian stock market has convinced itself that the US economy will execute a soft landing and avoid a recession. This combined with the imminent rate cuts has kept the bears at bay. This is good news for everyone who is long on the market. However, we at Equitymaster would like to sound a note of caution. The overall valuation of the Indian stock market is high. This means that the risk to investors buying stocks is also high. There are two broad measures to judge this: the Nifty PE ratio and the small cap to Sensex ratio. The Nifty PE ratio measures the valuations of the Nifty. It can be used as a proxy for the overall market's valuation. The small cap to Sensex ratio measures the valuation of small caps. It tells us how overvalued or undervalued the broader market is. The small cap to Sensex ratio is important for another reason. It acts as a proxy sentiment indicator. Retail investors are the driving force behind the Indian stock market. They are most likely to be over-invested in small caps. So this indicator tells us how much risk retail investors are willing to take. A Nifty PE ratio above 25 is historically seen as a level where the market is considered to be overvalued. A small cap to Sensex ratio above 0.65 is considered to be overvalued by Equitymaster's small cap editor Richa Agarwal. At the time of recording this video, the Nifty PE ratio is 23.6 and the small cap to Sensex ratio is 0.69. So we conclude that investors should stick to the sound principles of fundamental analysis, pick stocks for the long term, and keep speculation to a minimum. And if you're already doing this, then you don't need to worry too much about interest rates or what the US Fed could do next. Happy investing.